Hi, it's Michael Farr from Farr Miller in Washington. Thanks for tuning in again and joining me. I'm sorry I was out the past couple of weeks. I had a wonderful trip to Italy where I can report that Italians still seem to have plenty of money even though the Italian government may not. The food is still delicious and the dollar-euro was very attractive. Get a really, really good bottle of wine for about 25 euro at a pretty good restaurant. Take your trips now. Weather was lovely. We wrote this week about real high-quality stocks over the past year that have underperformed and some risky stocks that have outperformed. I want to take a minute here on the eve of the Fed decision and discuss risk versus return, because the lower risk stuff has not returned very well this year, while high-risk stuff has returned a lot. First, let's start with the markets and where they are. Here in the middle of September, the Dow Jones Industrial Average is trading at 16,700. At the low on August the 24th, we were at 15,370. So we're up about 1,400 points since the low 3 weeks ago, really. Now, the high so far for this year, and I think probably overall, was on the 19th of May, and it was 18,351. So, 18,351 in May to a rather deeper drop at 15,370 in August, and now at 16,702. Year over year, including dividends for the S&P 500, we are dead flat. Flat. It's actually down a couple of percent on price, but you add back in the dividend and we're flat. The 10-year Treasury, the yield has gone up and the price has come down. We're at 2.28%. That's a lot higher than that 1.8% or so that we got to when markets were fearful in August. Oil, $47 a barrel, and the euro is at $1.13. So still low, and that's been pretty stable. There was a very important paragraph, I think, in the market commentary today. After almost 7 years since the low and 7 years of a bull market since 2008, investors now forget the pain of those past plummets. They become less concerned about risk because they haven't had to endure any of the pain of consequence of a real market drop. After long uptrends, investors focus on the gains they may be missing, where not long ago they were worried about just protecting their principal. This is an emotional shift. Remember what I've always told you, emotion is the foe of the long-term investor. When you get emotional, you make mistakes. I'm trying to warn you now that you might be getting emotional and not realize it. Our advice is unwavering. Be cautious, be disciplined, be dispassionate, and be wise. What I've just told you is that everything's still very expensive. Economic data are coming in slow. CPI today, the Consumer Price Index, and remember this is a consumer-driven GDP, CPI actually came in negative, just barely, but negative. So the consumer isn't driving this huge economy anywhere fabulously fabulous. So think if I were telling you that the markets were really high and the economic data average, I have a lot of gains in my stock portfolio, should I add some more risk? I think you'd tell me no. I think you'd tell your children no. I think if you thought about what your parents or grandparents might advise you when presented with today's data, you'll know exactly the right thing to do. Listen to that voice of wisdom in your head. Don't take outsized risks. Be patient and know that you've got a great portfolio, well ahead probably of where you ever thought you would be. Don't get greedy. This could go on a lot longer where things that are very solid don't do as well and risk continues to do well. Don't be suckered close to the rocks by those siren songs. It's still very difficult to invest. It's still very easy to lose money. Make sure you have a chair when the music stops. I'll talk to you again next week. Thanks so much for tuning in. I'm sorry I went a little long. In Washington, D.C., for Farr Miller and Washington, I'm Michael Farr.